Shopify Inc. is currently trading at $154.01, representing a sharp intraday drop of 8.02% as of midday trading on January 14, 2026. While the headline figure of an 8% slide looks like a standard tech correction on a nervous market day, the reality hidden beneath the surface suggests a more complex shift in the e-commerce hierarchy. Investors typically expect Shopify to be the untouchable titan of the direct-to-consumer world, a company that stays insulated from the volatility hitting names like Tesla stock or Apple stock because of its massive merchant base. However, today's movement proves that even the giants have points of failure when the market begins to question the high premiums paid for future growth. The immediate trigger for this sell-off isn't just a broad tech pullback or the rising price of gold and oil, it's a direct challenge to Shopify's dominance in the form of a $100 million funding round for a scrappy competitor called Swap Commerce, backed by heavyweights like DST Global. This creates a curiosity loop for any serious participant in online investing. Is the moat we've been told about actually as deep as we thought, or is the software landscape becoming so fragmented that even the best platforms are losing their grip? Most people looking at an individual brokerage account today see red and assume it's just a bad day for the Nasdaq. But the expectation for Shopify was that its Winter Edition 2026 and the introduction of agentic commerce would provide a permanent floor for the share price. The market narrative has been that Shopify would basically own the way people buy things through AI chats, with their new tools allowing products to be sold directly inside platforms like ChatGPT. This was the big hope for 2026, and yet the reality of the price action today shows that investors are suddenly less interested in what might happen and much more concerned about who is taking market share right now. When a competitor like Swap Commerce raises substantial capital to specifically target Shopify's merchant base, the valuation multiple of over 100 times earnings starts to look very fragile. If you're using something like Schwab Intelligent Portfolios or other intelligent portfolio tools, you might see these swings smoothed out, but for those doing self-investing or using an individual brokerage to pick winners, this 8% drop is a loud signal that the high-growth story is facing its toughest test in years. The trading volume today has already surpassed 4 million shares by noon, a pace that suggests institutional players are rebalancing their exposure. We are seeing a significant amount of activity coming from institutional names like Jennison Associates and Norse Bank, who have historically been massive supporters of the stock, but are now navigating a landscape where retail data is coming in mixed. While some reports suggest shoppers spent more in late 2025, the underlying reality is that big-ticket items are lagging, and that directly impacts the gross merchandise volume Shopify processes. If you look at your Fidelity or Robinhood app right now, you'll see the stock is hovering just above its 50-day moving average of $160, but breaking below that level could trigger a much larger technical breakdown. Comment below how many shares of Shopify you currently hold, or if you are moving that capital into other areas like Nvidia stock or diversifying through Fidelity ETFs. This kind of interaction is crucial because the sentiment on the ground often precedes the next major move in the charts. When you look at the broader landscape of online investing, it's easy to get caught up in the hype of new features, but the real story of Shopify is its ability to turn small entrepreneurs into global brands. They've captured about 30% of the U.S. e-commerce business market, which is an incredible feat of engineering and sales. Their business model relies on two main pillars: subscription solutions and merchant solutions. Subscription solutions are the recurring fees people pay to use the platform, while merchant solutions, which make up the lion's share of the revenue, come from payment processing through Shop Pay, shipping, and financing. This is where the competition gets fierce. Every time a new player enters the digital payment space or offers a cheaper way to handle logistics, it chips away at the premium Shopify can charge. For someone doing their own online investing, the question isn't whether Shopify is a good company, it clearly is, but whether it's a $200 billion company at a time when growth in the mid to high 27% range is starting to be viewed as the new normal rather than an exception. Past performance used to be a point of pride for Shopify bulls, especially the massive run-up from the pandemic lows. They saw 10 years of growth packed into a single year, but that created a set of expectations that are almost impossible to maintain. After several years of restructuring and moving away from their own logistics network to focus on software, they finally started delivering consistent profits. In fact, they've had 9 straight quarters of positive operating income, which is why the stock was able to hit new highs late last year. But the market has a short memory. It doesn't care about the $1 trillion in cumulative order value processed in 2024 if the 2026 outlook looks even slightly murky. Analysts at places like TD Cowen and Scotiabank are split, with some looking for a target of $200 while others remain cautious with hold ratings. This tug of war is exactly what we're seeing play out in real time today. If you're managing your own money through an interactive broker's platform or checking your Fidelity brokerage account, you have to decide if this dip is a buying opportunity or a warning of a deeper structural shift in how people shop online. The future outlook for Shopify is heavily tied to their agentic vision, where software agents handle everything from discovery to checkout. They've partnered with OpenAI and Microsoft to ensure that when someone asks an AI for a gift recommendation, a Shopify merchant is at the top of the list. It's a smart move, but the risk is that these AI platforms might eventually want to keep more of the transaction fee for themselves, or that consumers will simply stick to the biggest marketplaces like Amazon. There's also the macroeconomic pressure. With the rising costs of living and shifts in global supply chains towards Southeast Asia and Eastern Europe, the cost of doing business for small merchants is going up. Shopify has tried to mitigate this with tools like Shopify Managed Markets to help with international sales, but they can't control the global economy. This is why many people seeking investment help are being told to look at more diversified options like Fidelity mutual funds or SoFi ETFs, rather than putting all their eggs in a single high-beta growth stock. Looking ahead, the catalysts for a recovery would be a stronger than expected earnings report in the next quarter or a successful rollout of their new AI features that shows a clear increase in merchant conversion rates. On the flip side, the risks are clear. If interest rates stay higher for longer, or if the AI bubble that some analysts are worried about finally pops, Shopify will likely be the first stock to feel the heat because of its high valuation. It currently trades at a price to earnings that assumes almost perfect execution. When reality falls short of that perfection, as it did today with the news of new competitive funding, the market reacts violently. For those using the Robinhood app for Robinhood stock trading, or those with a Fidelity trading platform, the volatility is both a threat and a chance to reevaluate their positions. The tension between the expectation of Shopify becoming the operating system of commerce and the reality of a crowded, price-sensitive market is what will drive the stock for the rest of 2026. As we summarize the insights from today's movement, it's clear that the 8% drop in Shopify isn't an isolated event. It is a collision between the optimistic narrative of AI-driven growth and the cold reality of intensified competition and macroeconomic uncertainty. We saw how expectations were built on the winter edition features, but were quickly challenged by the capital flowing into rivals like swap commerce. This is a classic case where the market's belief in a company's total dominance is being stress-tested by the emergence of new, well-funded alternatives. Whether you are using SoFi Active Investing, Interactive Brokers, or managing Fidelity IRAs, the key is to look beyond the daily swings and understand the structural changes happening in the background. Shopify remains a powerhouse, but the days of it being an easy set-it-and-forget-it growth stock are over. It now requires the same level of scrutiny and active management that you would give to any other high-stakes investment in your portfolio. To stay ahead in this environment, it's important to utilize all the tools at your disposal, from the Fidelity mobile app for quick trades to more robust platforms like interactive brokers for deep technical analysis. Investing sites are full of opinions, but the price action today tells the most honest story. The stock has pulled back to a level that will either act as a launchpad for the next leg up or serve as a gateway to a much deeper correction. If you're involved in online investing, keep a close watch on the trading volume over the next few sessions. High volume on down days usually suggests that big money is moving out, while a quick bounce on low volume might just be a temporary relief rally. Whatever your strategy, whether it's through Schwab Intelligent Portfolios or a more hands-on approach with an individual brokerage, staying informed and being willing to challenge the prevailing market narrative is the only way to protect and grow your capital in a year as volatile as 2026. In the end, Shopify's story is a